One of the most appealing parts of real estate is the potential to build wealth that can last generations. By generational wealth in real estate, it could be passive income, it could be the equity of the properties, or both. Today, we want to chat a little bit about current dangers in the real estate market if you're planning on building generational wealth. And of course, we'll share some ideas of how you can overcome those dangers and keep your real estate empire in the family.
Hey, and welcome to Wealth Wisdom Financial Podcast. We believe when conventional financial thinking doesn't get you where you want to go, you need wealth wisdom. Hit that subscribe button, and if you're watching on YouTube, give us a comment and a like. Those really help.
Yep. So we're continuing a little series about real estate. If you missed our last two episodes, we invite you to go back and watch them or listen to them. The first one is about why we love real estate investors. And the second was an interview with a very wise mortgage broker about managing the equity of the properties that you own.
Now, before we jump in, we do want to remind you that we are not tax professionals. Plus, what's true for most might not be true for you. Again, we want to say that we are not tax professionals, and what is true for somebody else may not be true for you. Take everything we're about to share and weigh it alongside a qualified professional to decide what fits your unique situation and what is for someone else. Don't just do this with our information either. Do that with all the info that you learn from. We see people make mistakes, seriously, all the time, almost like every other day, where they operate with information that doesn't apply to their specific situation, and then they wonder why they're in deep hot water or challenges.
Yeah, especially with real estate, there's so many different ways to do real estate. Beginner, intermediate, advanced. If you're learning advanced concepts as a beginner, you could do things wrong. So That's why you work with a qualified professional. You have a financial ally. Now, what we're going to talk about with generational wealth has a lot to do with the tax code. That's why Brandon warned you we're not tax professionals. But we're going to talk a lot about taxes today.
It all interconnects.
Well, and generational wealth, the IRS is often who gets the generational wealth instead of your heirs. So there are 6 common tax advantages that you might hear in your usual real estate circles, but a 7th that doesn't get a lot of discussion. We're going to focus on number 7 today, but we'll remind you of the first because they're important too to remember. And here we go. We're going to go through them quickly. The first star.
So number 1 is depreciation. You'll hear this all the time. You get to deduct the cost of buying and improving a property over its lifetime, little by little, typically lowering your tax bill. And that's a great thing to lower your tax bill.
Yep. A 1031 exchange, you can take the equity you built and transfer it to a like-kind property without any taxes due at the time of transfer.
You can deduct expenses. Ongoing costs like property management and utilities can be deducted from gross income. That's a cool one.
Number 4, passive loss rules. If you lose value in one passive venture, you can write it off against passive gains from another.
Real estate professional status. So if you're able to make real estate your full-time or main gig, you get extra tax advantages.
Yep.
I don't know. Are you going to be a real estate?
No. Number 6 is you can use tax qualified accounts like self-directed IRAs. This is one area where that's often promoted, and yet it's not good for everyone. So be very cautious with this one. But the idea is you don't have to pay taxes on the income as you use it. You can let that income build up and then use it, after you're 59 and a half without penalty, use the self-directed funds to be able to do the real estate investing without penalty, all those kind of things. Just know that you lose some of those other 5 tax advantages we just shared when you choose this one. And there's some potential to lose the advantage of number 7 that we're going to talk to as well.
Yep. For the experienced real estate investor, some of those are going to be old news. Let's see if you know number 7, though. The 7th is called buy, borrow, die, or BBD for short, buy, borrow, die. The essence is that you buy an asset, you never sell the asset because then you owe taxes on the gains. Instead, when you want cash, you borrow against the value of the asset. You might borrow and refinance multiple times. Then eventually you die and your heirs receive a step up in basis, which means that if they sell it upon your death, they don't need to pay taxes on the additional equity you built during your lifetime. Buy, borrow, die, never sell.
BBD isn't just for real estate investors, it's used elsewhere, but let's focus on real estate. The buy, borrow, die strategy has some powerful benefits that are maximized for real estate investors. And Brandon's going to go through those powerful benefits for real estate specifically. And then I'm going to share a little bit of how some of those benefits are in danger right now. And then we'll talk about maybe some of the ways that you can mitigate those dangers as we go through the conversation. Sound good? So we're going to go through buy, how it works for real estate investors, the dangers, borrow, die, or do that for each one. And then we'll talk about how you can mitigate some of those afterward. Okay, kick us off.
Yep. So for the first one is, of course, buying real estate. Buying real estate is buying a potentially appreciating asset that also could provide income. Real estate has a history of being a relatively stable asset class with the potential of appreciation over time. That's why people love it, right? The potential for appreciation continues no matter how much you borrow against the asset. It's not like property values with loans are worth less than property values with loans.
Without.
Yeah. Similarly with the income. If it's a rental property, whether long-term, medium, short, commercial, residential, single family, multifamily, or apartments, I mean, that's a mouthful right there. So many different ways to do real estate. The rents come in fairly consistently, even while the property is appreciating. Selling the property actually stops the income. So you no longer have rents when you sold it.
Yeah. So of course, real estate doesn't always appreciate. You don't have to look too far back to the Great Recession when home values plummeted. Today, while the danger of losing equity definitely exists, the other danger is the ability to have control over the income that you get from a property. Government mandated rent control is an issue right now that people are talking about. And we looked it up. It actually dates back to at least the year 1470, 1470.
1470. That's a long time ago.
Yeah, the 15th century, when Rome instituted a rent control to protect Jewish tenants from Christian landlords who are price gouging only on Jewish tenants and not on other tenants. So it was a form of removing bias at that time and discrimination. Today, you might already live in a locality where rent control is in effect, probably for very different reasons. But just last year, rent control was up for serious debate here in Ohio. It was squashed for now, and we don't want to speculate about the future, but we want to remind you that buying a real estate asset does involve risk to both the equity growth and to the income.
So there's challenges there. Number two, now let's move on to borrow. Loans and lines of credits are not taxable as income. You could leverage the value of one asset to buy another, maybe even of a different asset class. You can borrow against one property to buy another, or to diversify and buy something not in real estate. I mean, this is the home equity line of credit that people use all the time.
Yeah, this is another area of danger, of course, this time by increasing interest rates or a more restrictive lending environment. It becomes less and less advantageous to use OPM, other people's money, as interest rates go up. Can you get enough rent to cover the full loan repayment and all the other expenses? How do you make sure you make those payments during vacancies? You might want to diversify, but how often will you need to tap into the other investments to fulfill your real estate needs and keep your debts under control? Plus, as we discussed in the last episode, there's no guarantee you can borrow against your equity anytime you want to. You have to qualify with loads of paperwork. You have to kiss the ring of a mortgage guy or a private money lender. If you're using a HELOC, you may think you're going to have funds available, but the bank could limit your availability at their own discretion.
Yeah, especially if you're a business owner too, you got to prove everything, right? It's so hard. Then there's the other part. This is the fun part. Die. I don't know. When investors pass on their real estate holdings to their heirs, they can transfer significant wealth while minimizing estate taxes through stepped up basis provisions. The unfortunate thing is they don't get to see that work that they did. And this can lead to intergenerational wealth transfer, helping future generations build a strong financial foundation. I mean, you think about it, this is probably what the Rockefellers did and a lot of those big families.
Yeah, that have kept money in their family from generation after generation. But even this part of BBD is in danger. The stepped up basis for heirs has been put on the chopping block a few times in recent tax law proposed changes. And if the stepped up basis is removed or maybe limited, even when you avoid taxes during your lifetime, your heirs may get a steep tax bill in theirs and have to take the wealth that you built and send it to the other heirs, the Internal Revenue Service. Keep that in mind. We want to come back to that later because this is one area that you might have more control than you think.
Yeah. It's important to note that the buy, borrow, die strategy may not be suitable for everyone, as it involves taking on debt and may also involve managing rental properties, which can be time-consuming and carries many other risks. Investors should carefully consider their financial situation, risk tolerance, and long-term goals before implementing this strategy, but I do think it's an amazing one.
Yeah, this one and many other strategies. And there are other ways to do BBD. Let me ask you this question. What if there was a way to buy, borrow, die that was safer and help you keep more of what's yours rather than pay a bunch of interest to a bank or other money lender while also saving on your tax bill?
Here's our favorite way to do buy, borrow, die. It's called the bank on yourself way, a wealth building system based on a properly designed whole life insurance policy. And this is something we've done personally.
We have lots of other episodes about it, but let me put it into the buy, borrow, die framework for you really quickly. Here's how it works. You buy an asset, in this case, the death benefit. You borrow against the equity of the asset, but never sell it. In this case, through policy loans. And a properly designed policy with the right company will ensure that the equity of the policy continues to grow exactly like if you've never taken a policy loan and you have complete control over the repayment terms. Essentially, the cash value becomes a line of credit rather than having to depend on a bank or other money lender or a HELOC or whatever way you would borrow from other institutions. And then third, you die, then your beneficiaries receive a death benefit income tax free.
Yeah, that's huge.
Without having to worry about a step up in basis.
Yeah, right. Here's what most people miss. There's the potential to combine the two. What if someone could buy the asset of a death benefit, use the policy loan feature to buy the asset of real estate, use the cash flow from the real estate to repay the policy loan, then they have two assets for their beneficiaries. And of course, they could rinse and repeat and end up buying a whole portfolio of policies and properties because they have done it again and again and again, and it just goes all over the place.
Yeah. And it's not just about their beneficiaries. It's also gives them income that they could use in their lifetime. Less interest is going to a bank, so they get to keep more of that, all of those fun things. And they save a bunch of taxes along the way too. So it's kind of this way to help your beneficiaries, but also have more that you can use within your lifetime as well. Now, what we found is that too many people start using whole life with the wrong professional. And then their dollars are competing with each other. Which ones go to real estate? Which ones go to whole life? How do we decide? If you're going to use a strategy like we're discussing today, you want to work with a professional who knows real estate, is a bank on yourself professional, and takes you through a comprehensive analysis to craft a long-term strategy that stands up to the twists and turns of real estate and your life and helps meld these two together so they're better together than they are competing against each other.
Yeah, I do got to say, I just had a text message from a client who told me the other day, I did a couple policies for him, and he's used his policies to buy assets. And he was telling me, he's like, man, everything you said happened. How do I start more policies? Because I have so many properties and it's doing amazing. What do I do? I'm like, man, that's a great problem to have. And it's because he started using that system to build this system.
Well, and it speaks to the point, like you did the comprehensive analysis when you first started, and he's been working this for a few years. As he's going, he's needed to revisit that, do a new comprehensive analysis, change up that long-term strategy. It's doing what he thought it would do, but he's also earned more income, got more properties, had more opportunities. So how does that strategy evolve?
Yeah.
A true bank and yourself professional is you're in contact with them regularly, you're updating things, you're keeping going.
But let's say the worst case scenario happened with real estate. Rents are controlled to barely over your loan payments, plus interest rates continue to skyrocket, and the lending environment keeps restricting. Plus, the step up in basis upon death is abolished. Does the policy still work to provide a backstop in the worst case scenario?
That is a great question to ask. Now, there are a bunch of more ideas of how properly designed bank on yourself type whole life insurance works to boost real estate and create generational wealth. Let's say the estate tax exemption gets zapped by the shrinking machine and your heirs end up with a major estate tax bill. In life insurance death benefit could be the liquidity. That means your heirs don't have to sell a property immediately and can continue to collect rent payments well into the future.
Now, if you'd like to connect with a professional who understands real estate and who specializes in banking yourself, we'd love to connect, answer your questions, and see if we should continue learning and confirming a strategy that works for you. And you can just go to wealthwisdomfp.com/call to request a meeting, and we'd love to help you break through to even smarter, stabler financial future and have lots of properties and lots of money for your heirs at the same time.
Yeah, so thanks for joining us. Hit that subscribe button so you don't miss our next episode. We'll be wrapping up the series on real estate. And then, of course, go to that link in the show notes, www.wealthwisdomfp.com/call to schedule a discovery call. And may you live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.
And may know a little bit of real estate and taxes.
And so forth.
And so forth.